Have you ever seen a stock where its price is just screaming superstar, but when you look at the actual company's finances, it looks like a total disaster? Well, that's the exact puzzle we're going to dive into today with a company called EchoStar, ticker SATS. We're going to put the market story up against the story the numbers are telling and see what's really going on. So let's just start with what the market is shouting from the rooftops. This number right here, that's the total return for SATS stock over just the past 12 months. I mean, wow, an absolutely mind-blowing gain of over 420%. You see a number like that, you think, this company must be crushing it, right? Firing on all cylinders. Well, maybe hang on to that thought for a second. Because you see, over that exact same period, this was the company's net income. And no, that's not a typo. That's a loss of over $14 billion. And right there, that's it. That's the heart of our paradox. A stock price that's gone to the moon, attached to a company that's losing a truly astronomical amount of money.
So this is the big question, right? How can these two things possibly exist at the same time? Is the market seeing some brilliant future that the current numbers just don't capture yet? Or is something else entirely going on here? Let's dig in and find out.
Okay, here's our game plan for breaking this all down. First, we'll look at that wild price explosion. Then we're going to pop the hood and see the company's actual numbers. After that, we'll run a quick Buffett-style checkup, looking at its profits and its debt. And finally, we'll put the price story and the business story side by side to see what we've learned.
So let's start with the story the market is telling us. And based on the stock price, man, it is a blockbuster of a story.
And you know, this isn't just some recent flash in the pan. As you can see here, if we look back 3 years or even 5 years, the returns are just huge. This tells us that the market has been really bullish on this stock for quite a while, just consistently pushing that price higher and higher.
All right, now for the pivot. Let's look at the story the company's actual performance data is telling. And you might want to brace yourself for a little whiplash because, well, it's a very different story.
And this is where things get weird. Net income? We already saw that. A loss of over $14 billion. Free cash flow? Also negative. That means more cash is flying out the door than coming in. And just look at that, return on equity, negative 251%. That means for every dollar that shareholders, like you, have invested in the company, the business is actively destroying value. Not good.
So, how on earth do we make sense of this? Let's borrow a simple framework from one of the greatest investors ever, Warren Buffett. He's famous for focusing on the real business underneath it all, not the stock market's crazy mood swings.
See, Buffett's approach isn't some super complex secret formula. It's actually refreshingly simple. He just looks for really great companies that consistently make money and don't have a ton of debt. He's not buying a ticker symbol, he's buying a piece of a business. So let's put SATS through that basic test.
All right, question number 1. It's the most basic and most important one. Does the business actually make money? Because that's the engine that powers everything else. So is EchoStar a profitable business today?
Let's circle back to that return on equity, or ROE. This is basically a report card for how well a company uses its shareholders' money to generate profits. You obviously want to see a positive number here. What we see is negative 251%. That's a massive, flashing red flag, signaling that the company is just burning through shareholder money.
Another key metric you always hear about is the PE ratio. All it does is tell you how much investors are willing to pay for $1 of a company's profits. But here's the catch. What happens when a company doesn't have any profits? Well, then you get a negative PE ratio, which is exactly what SATS has.
So on our very first test, profitability, it's a clear fail. Instead of the consistent positive earnings Buffett would want to see, we've got these huge losses and a negative PE ratio. Checkmark number 1 is just a big red X.
Okay, next up on our little checklist, debt. Buffett has always been super cautious about companies with too much debt because it can add a ton of risk to a business, especially when things get tough.
Here's a perfect way to think about it. Having too much debt is like asking a world-class athlete to go compete but making them wear a heavy weighted vest. It just slows them down. It makes every move harder, every little mistake more painful, and it really limits what they can do. It's just a constant drag.
A really common way to measure this is the debt-to-equity ratio. A lot of investors like to see this number below 1.0, which means the company has more of its own money than borrowed money. SATS has a ratio of 4.51. Whoa! That means it has 4.5 times more debt than shareholder equity. That's a really heavy weighted vest.
Okay, so let's bring this all home. What we have here are two narratives that are just completely at odds with each other. We have the story being told by the soaring stock price, and then this totally different story being told by the company's financial health.
And this is where that famous Buffett quote just nails it. Price is what you pay, value is what you get. The price of SATS has been going up like a rocket, but the value? Well, based on our quick checkup of the actual business, that's a much, much murkier question.
And this slide right here just puts it all out there, side by side. On the left, you've got the stock story, big returns, big market cap, lots of excitement. On the right, you've got the company story, the fundamentals. We're talking massive losses, tons of debt, and a deeply negative return for owners. It's like we're looking at two totally different things.
So what's the big takeaway from all this? It's that a stock's price can be all about excitement and hope for the future, a bet on what might happen. Its financials, on the other hand, are the cold, hard reality of today. And as the SATS paradox shows us, those two things are not always the same, not even close.
And that leaves us with one final and really important question. When you find yourself looking at a company like this, where the exciting story the stock is telling is in a head-on collision with the hard reality of its numbers, which one do you choose to believe?